We are back.
Sorry for the wait, man.
Today's stock analysis is of Service Properties Trust, stock ticker SVC, suggested by Detroit. From here on out, we will only be doing stock analysis videos, so drop your ticker symbols in the comments. SVC is an equity real estate investment trust, or REIT, who wield an extensive real estate portfolio which focuses mainly on hotels as well as net service retail properties. Equity REITs earn revenue by generating income from properties they own. Of the taxable income they earn annually, 90% is required to be paid out as distributions to the shareholder, and said distributions are then taxed at the investor's ordinary income rate. Although SVC is a REIT, holding this stock will be a growth play, as equity REITs in the hotel industry are currently paying little to no dividends at all. Service Properties Trust currently has a share price of $11.23 with a market cap of $1.85 billion and a 52-week range, ranging from a low of 6.77 to 15.39. This is beneficial because if you don't want to wait out SVC's full recovery to their pre-shutdown share price of around $25, there are much closer returns in sight, as their share price is currently sitting at 16% below that 52-week high. Something else we can look at which gives us insight on the recovery is this chart outlining booked nights over the past 3 years, reported by Guest-Centric. As the recovery continues and people are still deprived of travel, we have seen an increased demand for U.S. hotels, up 387.3% from last year and even 119.8% compared to the unskewed 2019 levels. This is reiterated by substantial recoveries in the market capitalizations of equity REITs within the hotel industry. Later on, we'll be looking at Service Property Trust's portfolio to see why they have yet to reach this same level of recovery as their peers. Unfortunately, SVC has reported negative earnings for the past 3 quarters, missing estimates by rather large margins, and currently posting an earnings per share of minus $3.20, but this should be unsurprising as they are still suffering aftershocks from shutdowns and threats of new ones. Coupled with their negative earnings, Service Properties Trust had to cut their dividend almost entirely, as did most other hotel REITs. Investors can expect to receive a single cent from SVC each quarter, with a dividend yield of 0.35%. Now yes, this may sound terrible, and although it is a result from not only the shutdowns, but the drop in share price alongside them, it does present a cheap buying opportunity, giving investors the ability to be rewarded by both capital appreciation as well as dividend increases. Once that dividend begins to rise, so will investor sentiment, and people will start coming back, bolstering the share price. With a price-to-book ratio of 1.04, we know that Service Properties Trust's market value is currently just above the value of their assets, which further illustrates the buying opportunity for investors. Although the balance sheet looks weak with total cash of $915 million towered over by $7.14 billion of debt, the company will remain solvent for at least the next year indefinitely, as their current assets are generating more money than required by their short-term debt obligations, which is communicated through the 2.63 current ratio. Additionally, SVC has a reported revenue of $1.2 billion and a gross profit of $567.35 million. The remaining numbers shown here are negative because of the shutdowns and should continue to increase alongside earnings and revenue per available room. Service Properties Trust currently has 1,108 properties spread across 47 different states. Their portfolio is diversified well, with 57.5% of it focusing on the hotel industry, while the remaining 42.5% of their assets are in net lease investments. Something which is noteworthy here is that California is the state which SVC has invested into the most, at 11% of their entire portfolio. Although the climate and location of California make it a good tourist destination, as well as their incredibly large economy, I do not like this because, for whatever reason, or plethora of them really, there's been large amounts of people leaving the Golden State. Although this may not directly affect SVC, if it continues, the negative effect on property value as well as commercial business will increase. Of the 310 hotels owned by Service Properties Trust, 46.7% of them are upscale, while 11.6% are the next step up, upper upscale. Creative, right? Many of these hotels used to be managed and branded by companies such as Marriott and Wyndham. However, SVC management was able to transfer branding to Sonesta, who they own 34% of. This shows management is not getting complacent with business operations and are still striving to improve upon themselves. Not only does this give us confidence in management, but it has proven to be effective for both SVC and Sonesta alike, as occupancy and revenue per available room have increased drastically. Although this data may be skewed by artificially low shutdown numbers, I personally believe that the new up-and-comers in Sonesta will result in much better returns than the old, boring, and poorly respected Marriott and Wyndham hotels. On the other side of the portfolio, Service Properties Trust owns 798 net lease properties with a 98.5% occupancy rate. Their average lease term is 10.7 years, which is very good news as it offers safety concerning the state of the economy right now. Additionally, they are diversified into a multitude of different industries, with 44.7% of their annualized minimum rent coming from travel centers of America. In my opinion, this may be one of the reasons that SVC has been lagging behind their peers in recovery, because they are invested so much into travel centers, and given the state of global health as well as open borders and just travel in general, this could present some problems in the short term. Taking a look at the 1-year chart, we can see that SVC is currently trending upward by taking a look at the 200-day dark gray moving average line. Additionally, SVC's share price of $11.25 is trading below the red 20-day moving average line, which tells us that a small price dip is occurring as the relative strength index at the bottom continues to drop. We currently see the RSI sitting somewhere in the middle there, but if it continues to approach 30 and the share price breaks out above the 20-day moving average line, a buying opportunity should be present, which is backed up by established support levels around $10.70. Analysts have set an average price target of $13.33 with a lower threshold of $12 and an upper estimate of $15, which I believe to be slightly ambitious in the short term compared to the charting that we just looked at. As the share price continues to recover, however, I expect these targets to rise alongside them. With that being said, it will be an uphill battle for SVC, and holding a long-term position in them while they are paying an essentially non-existent dividend may make you lose by opportunity cost. Let me know how you feel about investing in the hotel industry right now. Remember to subscribe to the channel and turn on notifications. As always, I'm Patrick Zimmerman. Thank you for your time. Have a nice day.